past, we've talked about the 7 most critical topics. Let's cover those a little bit today, just in case. There you go, in case someone is watching us for the very first time. So the 7 critical topics. Let's talk a little bit about those.
Yeah. So first, what are the 7 critical learning objectives? So on the screen, you'll see that we have a few bullet points here. These are the same topics that we teach at the college when we're teaching people how to prepare for retirement and what are the most critical things you need to learn about financial planning. We have to understand that there is a difference between average returns and real returns. What we're calling the real return is what do I actually get after all these things go up and down. Then we learn the concept of drawdowns, which are the top to bottom losses that a security or portfolio will experience through a market correction. And we learn through this that losses hurt more than gains help when you're in retirement.
Okay.
Then we also come back to the importance of Regulation 35D1. In a previous episode just recently, we talked about how this affects mutual funds and mutual fund managers. And because the majority of U.S. wealth is in retirement accounts like 401ks, 401ks hold mostly mutual funds. Mutual funds are governed by this SEC 35D1, the name rule. So we want to learn the importance of that. Also on the slide, we talk about strategic versus tactical investing. This is the difference between having the ability to risk off the cash. Most people, especially if they find that they're working with a broker, find that they're in a strategic type of investment, which is buy and hold. And that means that they're not risking off the cash, which is a fancy way of selling to cash before you lose everything in the next market downturn, and being opportunistic when the markets come back. The other thing is that people have to understand of all the different types of people who call themselves a financial advisor, insurance salespeople, stockbrokers, financial planners, there's only one type of advisor that has a legal responsibility to always put their client's best interests first, above their own interests, their employer, or anyone else. It's a legal requirement, and that's a fiduciary.
Okay.
The other thing that's important in that conversation is to understand that somebody who is a fiduciary and also has another securities license may not always be acting in your best interest. And that's a whole different conversation we can talk about at a different time.
Okay.
But for recaps right now, just understand that fiduciaries are the only legal advisor that have the legal obligation to put your best interest first at all times and have no conflicts of interest in the advice that they're giving to you.
Okay, and that's
really
very important to know, because a lot of people in the viewing audience may be working with someone who perhaps works for, let's just say, a big box firm. And so sometimes you can have people that are suggesting a product for someone because they're receiving a personal commission on that. We should talk a little bit about that as well.
Yeah, so let's come back to some of the importance of each of these topics.
Yeah.
Kind of just finishing up the list, though, we also have to understand that on that list, when we're going through this, after we learn these first 5 important topics, there's also something called the 4% rule fallacy. This is something that Stephen and I focus a lot on in our college education, because in the outside world, people have learned that, oh, if I get to some dollar amount and I'm able to just take some percentage of money out over a period of time, that I should be okay for the next 20, 30, or 40 years. The problem is all of that is a fallacy. It's based on a bunch of old data that no longer applies, and it also doesn't take into consideration important rules such as required minimum distributions and other increasing withdrawal rates that you have no control over.
Okay.
And then finally, the last thing on the list is sequence of returns. This is the most, I think, impactful risk of all the risks that are out there: market risk and longevity risk and interest rate risk and inflation risk. Sequence of returns risk is really, really important. And this is because first of all, the definition of sequence returns risk is that when 2 parts of the financial marketplace come together, that is, when are you retiring and what's happening in the market. So either the markets are going up or they're going down, and then the date on which you're retiring. When those 2 things intersect, your quality of retirement may be severely impacted based on the sequence of returns that happen from the period where you stop working and then moving forward. So imagine if somebody retires in a increasing marketplace, that they might actually have a pretty good chance of solid retirement. But if somebody was expecting for their portfolio to just keep going up, and they enter into retirement at a time when the markets are starting to go down, and it's at the same time that they're taking withdrawals to live on, to solve for their income needs, that person's quality of retirement may be entirely different. And so I think that's probably one where we can spend a little bit of time, either this episode or maybe in a...
if we can try to get to this episode, people love to learn about that. They don't, you know, 'cause a lot of people never heard the term, don't understand it. And when they really understand it, they can see how much their retirement, how big of a difference their retirement would be when you retire on a good market year compared to a bad market year. So, and just the impact it has over the next 10, 15 years during retirement. So,
absolutely.